Housing affordability has posed a persistent challenge throughout the second quarter, and this issue is anticipated to persist into the latter half of the year due to the sustained high rates. Despite a recent easing of inflation to around 3% in the preceding months, rates have escalated over the past 2 weeks, driven by anticipated increases in food and energy prices in the upcoming months. With limited prospects for substantial inflation reduction in August and September, there exists a possibility that the Federal Reserve might enact one additional policy rate hike before the year's end. Consequently, mortgage rates could remain elevated for an extended duration compared to prior market expectations. The latest data from the California Association of Realtors reveals that housing affordability has hit its lowest point since 2007, largely due to the prevailing high rates. In the second quarter, only 16% of households in California could afford to purchase a standard single-family home, marking the lowest percentage since Q3 2007. Escalating mortgage rates have continued to propel borrowing costs to unprecedented heights, contributing to an 8.1% surge in mortgage payments from Q1 2023 and a 5.3% increase from Q2 2022. To afford a median-priced home with a monthly payment of $5,200, a minimum qualifying income of $208,000 was required, assuming the prevailing 30-year fixed-rate mortgage of 6.61% in the state. This minimum income requirement in Q2 2023 reached a new record high, marking the second instance in the past 3 quarters that it exceeded $200,000. Given the current trajectory of interest rates, which are near their highest point in the last 17 years and expected to remain elevated for the remainder of the year, the challenge of housing affordability is likely to persist for prospective homebuyers in the upcoming quarters. Although July witnessed a continued moderation in inflation, there is potential for a slight uptick in August. Despite the annual rise in headline inflation from 3% in June to 3.2% in July, the monthly increase of 0.2% last month represented a continued moderation from the average gain of 0.5% observed in 2022. Concurrently, core inflation experienced a gradual decline on a year-over-year basis, dropping from 4.8% in June to 4.7% in July, with the 3-month annualized average of 3.1% marking the slowest pace since September 2021. Housing prices sustained their upward trajectory but cooled from early 2023, while the prices of used cars, trucks softened further in July and airline fares experienced a significant decline on a year-over-year basis. However, the downward trend in headline inflation could potentially reverse in the coming months due to a resurgence in gasoline prices and an upward movement in producer prices for food in July. Geopolitical tensions and weather-related factors might further exert upward pressure on food and energy prices, potentially disrupting the downward trajectory of inflation in the next few months. Consumer sentiment exhibited minimal change in August after reaching a 21-month peak in July, according to the University of Michigan's Consumer Sentiment Index. The August 2023 index declined slightly to 71.2 from July's 71.6 but remained notably higher than the all-time low of 50 recorded in June 2022. Consumers displayed a more favorable outlook on prices, as their year-ahead inflation expectation marginally decreased to 3.3% in August from 3.4% in July. Nonetheless, the current reading remains elevated compared to the 2.3% to 3.0% range observed in the 2 years preceding the pandemic. While consumers appear to believe that inflation is cooling, their perception of interest rates remains unchanged. A majority of consumers still anticipate a rise in interest rates over the next year, although their projections might have been influenced by the upward trend in rates since late July. Interest rates have been on a steady incline since early April, reaching the highest level in 9 months. The average 30-year fixed-rate mortgage climbed by 5 basis points, reaching 7.24% on August 14, 2023, as reported by Mortgage News Daily. Despite expectations that cooler inflation in July would lessen the likelihood of the Fed's next rate hike and reverse the upward trend in rates witnessed over the past few months, rates continued to rise following the release of the Consumer Price Index and the Producer Price Index. Despite the short-term elevation of oil and food prices and the increasing probability of achieving an economic soft landing in 2024, the prevailing sentiment in the market is that the Fed might maintain its policy rate for a slightly longer period. Consequently, rates have continued their ascent over the past few weeks, defying the cooling trend in inflation, and are projected to remain elevated throughout the third quarter, until the Fed conveys a more definitive message to the market regarding its next rate adjustment. Small business optimism has witnessed improvement yet again in July, marking the third consecutive month of growth, with the index reaching 91.9. Despite this increase, the index remains below the historical average of 98 for the 19th consecutive month. Small business owners exhibited heightened positivity as inflation eased, economic conditions improved, and expectations for future sales surged. Although 42% of business owners still grappled with challenges in filling job openings in July, this percentage decreased from its recent high of 51% recorded in mid-2022. The enhanced optimism has also translated into increased capital expenditures in the future, as 27% of owners plan to enhance capital outlays in the upcoming months, reflecting a 2 percentage point rise from June.